Right, good afternoon, YouTube. Thank you, as always, for joining us. It is Tuesday, the 20th of September. This is the first day of the two-day FOMC meeting with the rates to be announced tomorrow, and that will really be the main course for the week. You would expect, especially following those super hot inflation, the CPI numbers last week, which really gave the markets a little bit of a kick. We'll expect to see some interesting comments from Powell, given that volatility. Just to kind of recap what we saw last week, the Nasdaq was the one most affected by those moves. Just to kind of put this into some sort of perspective, it had a monster sell-off on Wednesday when the CPI numbers came in at headlines 8.3. The month-on-month increase was 0.6 versus an expectation of 0.3. So needless to say, the markets weren't digesting this very well at all, and we've really barely got off the floor since then. And we have started a little trying to counter rally yesterday, but all of that has been giving up a little bit today, which we'll come on to talk about further when we talk about the yields. But let's have a little look at the market this morning. Some of the data that's been released, those of you who are on this morning will know that the German PPI numbers that came out, believe it or not, the 7.9 is a month-on-month figure. The year-on-year figure makes for a pretty ugly reading at a whopping 45.8% PPI. Astronomical levels of inflation for the producer price index in Europe. And needless to say, the DAX was suffering this morning. We're seeing the DAX down 1.5%. It's leading the way to the downside. Euro stock's not far behind at 1.4 and pretty much red across the board on the indices. But really, since that number came out at 7, a little bit of a rally up towards kind of key levels. We had a little bit of resistance on the weekly value area highs here, which was an area I was looking to short. And yes, since then, it's been quite clear to the downside. And yeah, very aggressive moves to the downside on the DAX today. It's going to put it in some sort of perspective from those highs. We're off currently over 230 ticks. So pretty linear price action and consolidating around these lows. Not looking like the most bullish of price action whatsoever for German indices. The other data out today, we had the Canadian CPI reading. So the CPI was expected to come in down a little bit from the previous month. Month-on-month expected down 0.1%, and it was quite a bit softer actually, minus 0.3%. If you have a look where we are on this is the first kind of negative read we've had really, where are we, since January. So since this inflation story has really started to gather pace, this is the first negative read that we've seen on the Canadian dollar, and the fact that it's surprised to the downside, I think, is one of the reasons we're seeing some decent strength in some of the currency pairs. As you would expect, when the Canadian, when CPI is lower, you would anticipate that that's less likely that you're going to see more aggressive rate hikes. And if you have a look at let's have a look at the dollar CAD, for example. The dollar CAD is rallying given the kind of softer Canadian side of that, given that the softer inflation numbers suggest there'll be less rate hikes, and currencies tend to weaken when that is the case. And we're seeing that sort of price action quite nicely, really, since that number was released at 130. Decent moves from there on the dollar CAD. Where are we? We're up just over 40 ticks currently. Not the most dramatic, nothing compared to Wednesday last week, as we saw with that huge volatility on the US CPI. Nevertheless, a nice little trade in there for those of you who got on it. So what's the story? Why are we seeing some more negativity today? Well, obviously we had the negative CPI numbers, PPI numbers, positive PPI numbers, bad for the markets, numbers out of Europe. But furthermore, the real story is underneath the hood here on these yields. So if I bring you to a daily chart of the US 10-year yields, we noted this this morning, that we popped above highs for the year yesterday on the 10-year yield, and now we are aggressively pushing hotter, nearly at 3.59, just shy of there now. Not seeing these sort of numbers, and you have to go back on a weekly chart really to see back to May of 2011, the last time we saw these sort of figures. Not too far from taking out that swing high at 3.7, so that's the number I've got in mind. And then the next target will be 4%. Who knows? We've been putting on yield appreciation all year here, so it wouldn't be for me to say where this will stop. But I know terminal rates are now being priced in a little bit higher, and that's very much on the radar for the Fed as we move through into their rate decision tomorrow. Just talking about the US, if we have a look at the Fed's pricing model, the Fed funds futures. Earlier this morning, we had an 83% chance of a 75 basis point hike and only a 17% chance of a full 1% hike, which wasn't on the menu whatsoever this time a week ago. And the chances of that hike have increased a little bit today. The yields have been creeping higher. That's not surprised to see. So the implied probability is maybe a 1 in 5 chance that we get a 1% hike tomorrow night. And this is really where our focus will be. So at Educate to Trade, we do a lot of Zoom calls, as you guys will know, seeing a few of them on YouTube. But each morning we do, 8 a.m. or 7:50, just before the European market opens, live with you guys. Same thing again at 2:20. But with big events like we're seeing today, tomorrow, the FOMC Zoom is our biggest, the longest Zoom of the data cycle. So we'll be on with you from 6:50 tomorrow, which will take you through, first of all, the rate decision at 7 o'clock, where we'll get the Fed funds rate, which will be the big one, followed by the statement released at the same time. And then we'll take you through the start of the press conference. We're normally on till after 8 o'clock with you guys as Powell starts to, silver tongue his way through the difficult financial conditions he appears to be talking about. Given that it's quite clear on that inflation data last week that they are not getting this under control yet. And I mean, this is with rates currently at around 2.5%. I think by, in 36 hours time, we'll be looking at least 3.25. Can he raise it by 1% and talk the market up? If anyone can, Powell can do it. He is the man with the silver tongue. When he speaks, markets normally respond positively. So if he can manage to engineer a 1% interest rate hike, that is dovish. The caps will be doffed to him because he has an amazing way of getting these things done. But nevertheless, we'll be with you. If he is starting to suggest that they aren't in control of this yet, then the likelihood is that the indices are not going to like that at all. We'll be very, very much on those trades if they come. But always worth waiting for, keeping some bullets till he starts speaking in this press conference, because 7:30 has often been the kind of low in the market. Certainly kind of like 3 of the last 4 meetings we've had, you can almost buy that 7:30 time print with a really tight stop, and you can run it, good 300, 400, 500 ticks sometimes, depending if you're in the Dow, sometimes a little bit more than that. So that'll be something we'll be paying very close attention to tomorrow. And as a result, I wouldn't be going too gung-ho today or even tomorrow. I know this office will be very quiet in the afternoon tomorrow. People are already playing tennis and golf, I think, ahead of the big news out at 6:30. Because if you are at your desk trading the European session at 7, 8 o'clock in the morning, if you're still at your desk come 7:30 in the evening, you will not be optimal. So if you are trading the European session tomorrow, give yourself a bit of a break in the afternoon, as a lot of us in here will be doing. And that will hopefully allow you to have a kind of clear state of mind and clear objectivity when we do start to get first of all, the rate hike, how much that will be at 7 o'clock. Really reading into what he's talking about in initially his statement that he speaks about at 7:30, but then answering the questions from the media as they start to come through after that 7:30. We always get some nuggets in there, so hopefully he will not disappoint tomorrow. Through the rest of the week, while we're on, I mean, it doesn't stop there. We've got the Bank of Japan are out Thursday morning. It's always tentative. It's normally around 4:30, but you might want to set your alarm a little bit earlier than that. They've also got their CPI, their core CPI out at 6 a.m. They will know this figure before they get a good read on it before they do their policy rate. And obviously with the core figure not quite north of that 2% target, if we do get some more hawkish tones, and there has been some views that the Bank of Japan are ready to pivot, given that their currency from March went from 114 against the dollar to those highs just around 145. There has been chat that they are looking to try and firm that up. The easiest way for them to do that will be to start a rate hike cycle, because they're currently sitting sub-zero at minus 0.1% for their base rate. So any nudges in that direction, there's so much money borrowed out of Japan and stuck into these high yielding currencies in what's known as the carry trade. So if they start to make it a little bit more expensive to borrow money, a lot of that money might come home, and you can see some very swift declines in the dollar yen market. And given how aggressive we've been really since March, to give up some of this would not be too much of a surprise. There's a long way for it to fall if they do indeed pivot. It doesn't stop there. We've also got the Swiss National Bank, the biggest hedge fund in the world, as it's known. They own a lot of foreign exchange reserves and a lot of foreign equities. I think they're the 10th biggest holder of Apple. So they own a lot of, they have about 100,000 Swiss francs per capita in FX reserves, so they'll be well insulated through these crises. So that's why often the Swiss is deemed as a good safe haven currency. They are very liquid as a central bank, unlike a lot of them who have to print money to get this done. And then the postponed from last week Bank of England rate decision is at midday on Thursday as well. So plenty to get through. Those kind of that 18 hours or so will be busy. So yeah, do try and trade mainly around these areas if you can this week. There will be big moves undoubtedly around these central bank decisions. So be prepared for that. So I've talked so long, we've missed the open. Indices, given that we've had these bond yields creeping higher and higher and higher in the US, that has kind of led to the S&P 500 trading towards its lows here, and we're kind of opening pretty much on the lows, which is quite unusual given how much of a decline we've seen already. To put it in perspective, on the S&Ps we're off over 1%, same on the Nasdaq and just shy of that on the Dow. So yeah, already very much on the back foot, but these yields are just keeping, this is a 5-minute chart, these are all 5-minute charts. This is continuing to kind of nudge higher as the yields on the open hit those highs. So yeah, very, very aggressive selling across the board. And you often see this with yields going higher. There's a propensity to move money out of stocks and put it into bonds when you know you can get north of 3.5% on your 10-year yield. It may, that's, as Neil was talking about in the Zoom this morning, that's more than you're getting on average from your dividends these days, and you don't have to take any risk in terms of price appreciation or depreciation in asset prices in stocks. That if you're trading bonds or buying bonds, you wouldn't have that risk. You know you're getting your lump sum back at the end, whereas with stocks, maybe there's a lot more downside to come. But as we watch the open, softer on the S&P 500, just touched the weekly value low there. S&P, so the Nasdaq is a bit more of no man's land, but the Dow's not too far off hitting those weekly value area lows as well. This is looking pretty heavy so far today. I wouldn't mind seeing a little bit of a bid into this to be able to get short it. Shorting into this much weakness to me isn't a trade. I think there's a much more kind of path of least resistance to at least take out some stops and test the strength of the short traders first before I'd like to try and get in. But let's see what the market gives us. Talking about bond yields, if we look at the 10-year again, this is something that you want to pay attention to if you trade other assets. For example, trading the gold market. Let me bring up a gold chart for you on a new price scale. And you often see this inverse correlation when the yields are rallying, gold tends to struggle. I know we're talking about this earlier on in the year, so this is a weekly chart. I'll bring this onto a daily time frame, it might be even clearer. But often when you get the highs in the yields and you kind of push these levels, gold can struggle. And then when they started to go again on the yields from those lows, then gold again started to take a nosedive. And given we've taken out those highs and gold's taken out these recent lows, these swing lows that we had from March and another one back in July, there is room to the downside for gold. Unfortunately, for those of you who are long, I think there is still, as long as these yields march higher, gold can be incredibly responsive on the downside. So just be conscious of that if you are trading the yellow metal, to keep half an eye on the 10-year yield. It is a very good indicator, kind of leading indicator as to where this gold market will go. Back to the indices, currently holding that value area low for the week on the S&P 500. We tagged it on the Dow as well. And starting to see a bit of we're just back towards where we were. It was almost a moment of green for the S&P. Not seen too much of that today. There it is again, just slightly above where we opened in the cash markets. But both have held so far this weekly value low as the 10-year yields start to give up. But fairly muted. It's not been the kind of cataclysmic sell-off in the first 5 minutes that you sometimes see on days like this. As I say, I'll be looking to hopefully see a little bit of a rally if I was looking to get short. And let's see what the market brings. But if you do want to join us tomorrow is going to be undoubtedly one of the most interesting FOMC rate decisions we see. We may see that full 100 basis points tomorrow. And if Powell comes on at 7:30 and manages to ease markets' concerns about a full 100 basis points, then what a guy. But from 7:30 we'll be listening to him, and you'll be able to watch it all live with myself and Jerry through from 6:50 tomorrow. So if you haven't already signed up, the link is below this video. So do sign up. You can pop your email in there for this one. And you'll hopefully be able to join us at 6:50 tomorrow evening. So if I don't see you for clients, I'll catch up with you in the morning, or Neil will at 7:50. And for everyone else, if you want to join us for that Zoom, 6:50 tomorrow, and the link's below. Look forward to catching up then. Cheers.